A stock dividend is something tangible. It's not an earnings protection, it's something solid in hand. A cash dividend is as sure as death and taxes. Warren Buffett. Today I'll be showing you 5 reliable dividend stocks that you can invest in to make $300 every single day. I'll show you how much you need, the time horizon, and the 2 strategies needed to capitalize on their potential. Be sure to stay tuned until the end though, as I'll unveil 2 dividend-paying stocks that have the potential to yield $300 daily returns in a remarkably short period, and with only a little investment. So let's begin. As we said earlier, we're going to have 2 distinct strategies today, each with its own kinks and targets. If you're an investor and you have a massive amount of money cooling in your account, or that you've neatly tossed away for retirement, then step number 1 will suit you far more. However, if you're an investor with more frugal capital and you just want to have your money grow over time until it's mature enough to pay you up to $300 per day or $9,000 every month, then strategy number 2 is definitely for you. So you see, when it all boils down to where you are right now from a financial standpoint and how patient you want to be. You can either bypass the waiting period with a large initial investment or sit tight with a smaller amount and wait until it blossoms. Either way, the goal is the same, making $300 a day in dividends. So with that out of the way, let's start with the stocks that are sort of based on the time it'll take to grow your initial investment to a level where it will easily pay you dividends worth $300 every day. Starting at number 5, we have American Express, known by the ticker symbol AXP. Now this stock has been Warren Buffett's go-to in the financial services industry. In fact, if you take a look at Berkshire Hathaway's portfolio, you'll notice that AMEX is one of its top holdings. There's a lot to like about American Express stock, starting with its growth profile. The company's first quarter revenue surged by 11% year over year, while earnings per share skyrocketed by 39%. Plus, management anticipates full-year revenue growth between 9% and 11%, with earnings per share increasing up to 17%. But what's even more attractive about this stock is its dividend. Earlier this year, AMX's management announced that the company will be increasing its quarterly dividend by 17%. And this really puts a lot of spotlight on the payout's recent impressive track record of growth. Since 2022, the company has consistently raised its dividends annually at rates ranging from 17 to 21%. And despite pausing dividend increases during the COVID-19 pandemic, American Express has still been able to maintain consistent dividend payments. This long, uninterrupted streak goes all the way back to 1985. But hey, let's punch the numbers to see how much you'll need to make up $300 per day in dividends. Currently, the company has a dividend yield of about 1.2%, which means to get $300 a day, or $9,000 every month, you will need to invest over $9 million in this stock right away. So it's pretty obvious that our first strategy isn't actually feasible for everyone. Only 22.7 million people in the United States have a net worth of $1 million or more. Stats show that you'll need a minimum net worth of around $11 million just to get into the top 1% of Americans by wealth. So realistically, it only means not a lot of people have $9 million currently lying around, especially to get $300 a day in AMX dividends. But here's the thing. For all of its amazing perks, AMX is not just about the current dividend yield, rather it's about dividend growth, or in other words, CAGR, which in this stock's case is 15.74%. And this brings us to strategy number 2. Here, you'll only need to invest about $15,000 and wait for your investment to grow for 20 years while reinvesting the dividends. And in case you're a bit concerned about whether or not American Express will continue to grow for so long, you can rest easy because there is still lots of room for dividend growth in the years ahead. In fact, I dare say that more dividend growth is almost inevitable. Similar to Visa and MasterCard, American Express operates a 2-sided payments platform, leveraging network effects. With 80 million merchant locations across 200 countries accepting AMX and 141 million active cards in circulation as of December 31st, 2023, it drove $434 billion in transaction volume in the last quarter of 2023. But guess what? There's something that American Express excels at that simply blows the competition away. You see, in addition to its role as a payments platform, American Express also serves as a card issuer. It underwrites borrowers, manages credit risk, facilitates ongoing payments, and provides perks and rewards to cardholders, setting it apart from other giants like Visa and MasterCard. Amex is so good that Warren Buffett had to give it its special mention in the 2024 Berkshire Annual Shareholders Meeting.
I think it's almost unmatched. I can't really think of any company that has it. American Express has a position in the credit card field, which I think is extremely strong. And part of that was part of the reasons for that is one of the directors that introduced a few.
So you see, these and many more are the reasons why Mr. Buffett clearly views Amex as a winning dividend stock, to the point where Berkshire holds about 21% of American Express. Next on the list, though, is Coca-Cola, known by its ticker symbol KO, a company that Warren Buffett believes is the best in the world. And no, it's not because it's his favorite drink. Hear him wax lyrical about it yourself.
They are the preferred soft drink, in something maybe like 170 or 180 out of 200 countries. Those are rough approximations from a few years back, probably, but that degree of acceptance worldwide is.
Warren Buffett has always said, when you find a truly wonderful business, stick with it. Patience pays, and one wonderful business can offset the many mediocre decisions that are inevitable. From a marketing standpoint, Coca-Cola is that business. A successful brand establishes name recognition, distributor networks, and retail relationships, safeguarding it from competition, and that's exactly what this firm does. From its iconic name to its global reach, Coca-Cola has moat written all over it. Warren Buffett knows that no competitor can come from the blues and take away Coca-Cola's huge market share. Instead, the company has consistently absorbed potential competitors and diversified its portfolio through acquisitions, such as the Ayataka Green Tea and Dasani Water. At the moment, Coca-Cola has a dividend yield of 3%, which is considerably higher than the S&P 500 index's average yield of 1.6%. Currently, this stock pays an annual dividend of 3%. So for strategy number 1, if you want to earn $300 per day straight from the first year, you would have to invest approximately $3.5 million. Now, these numbers may seem more promising than the $9 million demand from our previous stock, but stay tuned until the end because we'll show you the stocks that can generate $300 per day with minimal investment in strategy 1, and way less time commitment in strategy 2. For now, though, I'd like to point out 3 things about Coca-Cola. For starters, with products sold in more than 200 countries around the world, Coca-Cola is easily one of the most recognizable global brands in the world. Secondly, it's had consistent growth. Coca-Cola's market cap has reached over $250 billion. In 1988, when Mr. Buffett first started buying shares, the company's market cap was $16 billion. So it's amazing to see how far it's come. And finally, Coca-Cola is a dividend aristocrat that regularly pays quarterly dividends. In fact, it continues to raise its dividend each year. But where are we going with this? For strategy 2, Coca-Cola has a 10-year CAGR of 5%. So, with all things considered, in order to reach $9,000 in monthly dividends, or $300 a day with Coca-Cola stock, you would need to start with an initial investment of $15,000 and keep reinvesting the dividends for just over 18 years. But we're not even close to getting to the best part. Our final stocks will get you a minimum of $300 in less than 15 years. At number 3, we have AbbVie, known by the ticker symbol ABBV. And guys, there is a lot to unpack about this company. Many investors don't realize that Warren Buffett holds other sets of stocks that are completely different from those listed in Berkshire's 13F documents. Through New England Asset Management, or NEAM, a subsidiary of Berkshire Hathaway, the Oracle of Omaha has a sweet basket of stocks that do impressively well. Call it a secret portfolio if you will, but one of the amazing stocks under NEAM is AbbVie, one of the biggest pharmaceutical companies in the world. The company is a dividend king, with 51 consecutive years of dividend increases, and its dividend yield currently tops 4%. Plus, it's also got a pretty solid compounded annual growth rate of 13.98%. For strategy number 1, to earn $300 a day from this stock, you'll need to invest around $2.6 million right from the get-go. But how about strategy number 2? With only a $15,000 investment, it will take almost 17 years for your investment to be valued at an excess of $135,900, which roughly amounts to $372 per day. So, can you see how a strong CAGR can boost even a moderate current yield to grow and pay higher in years to come? Then just imagine what a stock can achieve with both a high dividend yield and a high CAGR. Our next stock picks tick both of these boxes almost effortlessly. So keep watching until the end because you don't want to miss it. Before we go into all that, let's give you a few solid points as to why AbbVie has got to be in your portfolio. AbbVie stock has shown remarkable growth consistency, boosting dividends by nearly 300% since its spinoff from Abbott Labs in 2013. With a robust profit-sharing ratio and ample free cash flowing covering dividends, AbbVie is poised for continued annual dividend growth of 10 to 15%. But that's just the tip of the iceberg. 2023 marked a significant transition year for AbbVie, as it faced a setback with the expiration of the patent protection for Humira, its former flagship drug. But while most are bearish about its future, the company has shown it's more than just a one-trick pony by demonstrating its resilience in diversifying its portfolio, with successful replacements like Skyrizi and Rinvoq, which have already generated billions of dollars in sales, ensuring a promising future. Additionally, AbbVie used its Humira profits to acquire Botox maker Allergan for a whopping $63 billion in 2020. All of these meant that sales only slightly dipped when Humira, which used to account for almost half of its revenue, lost some of its patent protection. Take a look at this interesting chart. With all things considered, the stock's combination of a healthy dividend yield, strong growth prospects, and sound financials makes it an attractive choice for long-term dividend investors. But remember, the stocks we're going to show you next will blow your mind. Next up, we have KKR Capital Corp, with the ticker symbol FSK. When it comes to income-paying stocks, business development corporations often offer some of the highest dividend yields. By lending to riskier segments of the market that banks typically avoid, BDCs provide investors with a reliable source of passive income. Enter KKR Capital with its high dividend yield of 14.1%. This specialty finance company provides financing to middle-market companies in the United States through debt and equity investments. These companies typically have earnings before interest, taxes, depreciation, and amortization ranging from $10 million to $250 million and are often overlooked by banks due to its perceived higher risk. Over the past few decades, U.S. banks' share of the senior secured loans market has declined from 33% in 1995 to 8% in 2021, per S&P Global Capital IQ. KKR bridges this financial gap, and as BDCs, they're regulated investment entities required to distribute 90% of taxable income to shareholders. But here's where this company takes the gold medal in its niche. You see, KKR predominantly holds first lien loans and trades at a notable discount to its NAV, offering investors a margin of safety. And when you couple that with the fact that the firm is enhancing its investment portfolio by swapping out lower quality legacy loans for higher quality KKR approved originations, you can't help but feel it's a glowing dividend investing option. Let's run the numbers and see its strengths in your portfolio. With strategy 1, you'll need just $700,000, which is staggeringly lower than any other stock we've talked about so far. But strategy 2 gets even crazier. With an initial investment of $15,000, You'll have made your $300 goal in about 13 to 14 years. And lastly, our top pick for this video is Arbor Realty Trust, known by the ticker symbol AB. This REIT has been one of the top 10 real estate investment trusts for its attractive valuation and strong dividend metrics. Arbor Realty Trust operates through three key platforms: balance sheet loan origination, GSE agency loan origination, and servicing, offering diverse and recurring income streams. Its multifamily-centric approach and involvement in various real estate lending categories strengthen its position. But while all that is pretty great, there are more reasons why this investment makes it to the top of the list. First off, it has a current dividend yield of 12.29%, and backing its strong dividend yield is an even stronger dividend growth rate of 14.14%. And additionally, as an REIT, it must distribute at least 90% of taxable income as dividends, making it attractive for dividend investors. So how do these numbers stack up? With a current dividend yield of 12.29% and a 10-year CAGR of 13.14%, based on these metrics, for Strategy 1, you will need to invest $730,000 right from the start. Now, it is slightly higher than our previous stock, but that's expected because of the lower yield. Nonetheless, it catches up to it in Strategy 2 thanks to its CAGR. Here, you'll also make a 13-year investment of $15,000. So you see, the combination of a high dividend yield and a strong compound annual growth rate, or CAGR, accelerates wealth accumulation towards the $300 goal in a short period of time. A high dividend yield provides immediate income, while a robust CAGR ensures sustained growth over time. This dual strategy maximizes returns by rapidly increasing dividend growth, capital appreciation, and exponential growth, facilitating the achievement of ambitious financial goals within a short time frame.